Welcome to the channel, and this will be the first video. So, disclaimers first. Do your own research and think or ask your financial advisor before investing in any asset. I don't hold any degree or certificate to advise, so all the characters and events quoted in this video are totally fictional and are only used for educational and entertainment purposes only. Let's go to the main topic, auction market theory. So auction market theory is the very basic and core principle of all markets. All markets basically run on two things. First is the auction and second is game theory. We will be discussing in the further videos on this channel about game theory. But first, we'll discuss at the moment about the auction market theory. What exactly is an auction? An auction is a process where bids or asks for a certain asset continue until a mutually agreed fair value is reached. What does that mean? Let's take an example, like real life example where we see auction, like players auction for a club, a house for a sale, or second-hand devices. Yeah, like we have seen IPL auctions, players get sold for like a lot bigger prices. The auction starts at, let's just say, 1 or 2 crores or 10 lakh, and like people, all the participants keep bidding and raise the price to 17, 18 crores. And when everyone in the room agrees that that's a fair value, the auction is completed, and yeah, the players get sold. Same thing happens with the house sale. We don't know what the actual price of a house is until the auction process is done and everyone agrees that that's a fair value and deal is same. It's funny, really funny how everything we humans do is an auction. We always try to look things in a relative term. So yeah, this is a meme, but yeah, I receive this, you receive that. Let's just take example of a job. You need to have some certain skills to apply for this job. I have these skills, and for that I will be receiving this kind of salary. That's it. There's an auction. You have a skill, you are providing the skill, they're providing your salary, you both agree, you're happy with it, and there's an auction. Auction is completed, you have the job now. So this is just an example of a job, but yeah, everything we humans do is an auction. There's another little example of like how auction process goes. Here's a simple example. Let's just say I want to sell my old phone. The best I can go to a shop, like consider this a market and exchange. Anywhere we can sell things. We will come to that in the later part of the video, but yeah, we go to a shop. The shopkeeper checks the phone and offers me 20K. If I don't think this is the fair price, I reject it. And the shopkeeper then raises the price to 25. If I find the price fair, we close the deal at 25K. And yeah, done. We both happy. I'm happy with the 25. He's happy with the old phone. And the auction process complete. This is basically an auction process takes and looks like. So let's dive in deep. There are two types of auction, sell side auction and buy side auction. Let's look at buy side auction. Buy side auction often occurs due to the strong desire to own something, or simply put, the greed. We will try to understand with example, and this example will also clear how the charts you see on TradingView or any other tool you see, like what's the base and how the charts are built, not just like some anyway. So what is the basic core principle of the charts and how are these charts built? Let's just say you are celebrating something and you need 100 kg apples for it. So what do? You go to the market. But like, let's be realistic, no one has 100 kg apples. So you go to the market, you move to different shops, you try to buy it all. So the first thing you do in the market is like go to the cheapest place. Like who is selling the cheapest? As you're a buyer, you want to buy cheap. So you go to the shop which is selling the cheapest. So there's a one shop who's selling at 90, he has 20 kgs. You buy it. So you need more 80. So you go to next shop who's selling at 95. He has only 15 kgs. You buy 15. You still need 65. You go to next shop. He's selling at 100. He has 30 quantity. You buy it. Now you still need more 35. So you go to next shop. You have like he's selling at 105 and he has only 10 quantity. You bought it all and you still need 25. By the time you do this, like there's a sentiment in the market, or just say the next shop keeper finds out like you're in a desperate need to buy 25 more. So what he does is like remove the price from 110, or let's say 105, and he just labels the price 120. But here, like he can do that, like there's no obligation. But now, as a buyer, you need 25 kgs anyhow. So you go to the next shop. He has 40 kg apples. You buy 25 at the price of 120. And now the current price is 120. Let's just say if I step into the market right now, just say like 20 minutes after you entered, 20 minutes before, I could have bought an apple for 92 bucks. But now, because of you, you move the price up, you were greedy. Now I have to buy apples at 120 rupees per kg. This is what happened. Let's just consider you took 5 minutes for moving from one shop to another. So let's just say from like 90 to 95, 5 minutes spent, or from 95 to 100, 5 minutes spent, 100 to 105, 5 minutes spent. Let's just say 105. You didn't go to these two places or these two price points, 105 to 120. There was a direct jump. So this is the jump, or this like you see like there is imbalance, we call FVGs or imbalances and stuff. This is what happens in those candles. Like there wasn't much resistance and there was a greed, and you see this big candles. Same thing happens on the sell side. Yeah, we will come back to that later on, but yeah, this is how, and this is the basic core principle of like how your candles are made. So yeah, buy side auction. Let's take a like fun example from daily life. Let's just say usually your rose costs 20 bucks, but on Valentine's Day it can be sold for 150. And despite the price hike, you will buy it because there's an urgency and market have adjusted its price according to it. We will buy it because there's a need. Suppose you trade sports card and you had a card of a underrated player, and if the player wins a championship tonight, you will see people will start bidding a lot higher for your uh, for the player's card. Same thing happens with share when there's a news or an event. Till this date, I haven't found any evidence that there's a direct or mathematical relationship between a company and its shares. We are just speculating on it. Even like let's just say a player has a good season in IPL. Let's say IPL, he has a good season. Next season, you will see in the auction, people are bidding more. Like we aren't sure, like, and not this any mathematical reasoning or anything. This nothing. We just speculating. He played last season well. He will play next season well. We just speculating and we are bidding up the prices. That's all there is. We humans do auction in everything possible. So the second is sell side auction. Sell side auction takes place when there is an urgency to dispose of an item, or simply put, fear. So let's just me ask you, can the prices be negative? Yes, there can be. Prices can be negative, especially when holding an asset becomes too risky. This is a price chart of crude oil. During the COVID times, price went down to minus 40 per barrel. Minus 40 is a big thing, that too for oil. Let's see, discuss what happened during the COVID. During COVID lockdown, people weren't driving vehicles, but oil orders have been pre-made. And they have to be pre-made because like you can't just instantly take oil. You have to pre-make manufacture and all that stuff. So there wasn't enough space available to store new oil. Violating the contract by not accepting the new oil could impact long-term deals. To make sure the situation to make the situation more attractive, so people could buy oil, discounts were offered, but there was a time constraint, like you need to get this oil out faster, and there was a risk, and coupled with fear drove the prices so hard, like they didn't just go negative. There was a desperation, and price went kept going down until we found buyers, and buyers were found at minus 40. This is how sell auction takes place. The same, the candlestick represent the same thing. Like there were no buyers, so we just simply jumped the price down to minus 40. So let's just take a funny example. Let's just say your girlfriend doesn't like you eating sweets because you get fat. So, but Yeah, but you have a stash of sweets at your place because you love them. But suddenly one day she decides to visit you. And to avoid fights, you try to get rid of the sweets as soon as possible or like before she comes. But like giving it away for free or like trying to sell it at a break even price, that will take time because no one will be interested to buy those from you at that time. But yeah, what can you do? Like just put a notice or tell someone like keep this 2k extra and keep the sweets too. Like you are paying minus 2k, like you're paying some extra, but you are getting rid of the sweets. Same happened with oil in during the COVID period. The purpose was to get rid of the asset. Here, the same thing, you are getting rid of the sweets. Both are driven by fear. So, same reason share prices fluctuate or go down. Same reason fear drives the market down, greed drives the prices up. So, we have seen the tomato prices go up from 20 to 400, then back to 2. Watch BTC from 69k to 16k, then back to 73. We need a market to facilitate an auction. Markets play a very important role, and it has only two roles: to advertise the price and to facilitate the auction. Imagine both side auctions, both we discussed sell side and buy side, where both sell and buy orders are coming and execute and getting executed, millions of orders per second. That's why you see the fluctuations or like the waves, like whichever side is dominant in that second, we move that way. It's a bit complicated when you look at the numbers. It's a combination of game theory, some mathematics, and then the domination of buyers and sellers, how the matchmaking is done. I will be covering all that in detail in the future videos, but get an idea that millions of orders getting executed, both sides, and getting the match, and then deciding who's dominant, that drives the prices up and down. But the logic remains the same as we discussed about how the auction is taking place. So I will give you a small touch on how business are done. Like, yeah, there are two types of businesses. First is business of making money, and second is business of ownership. If you look closely, there's only one business, and it's the business of ownership. As we discussed above, fear and greed, to have the ownership of the asset or get rid of the asset. But what about the ownership of the money? Money is also an asset, right? Like Nifty INR, Bitcoin US dollar, Bitcoin Indian rupee, IRCTC Indian rupee. Like Indian rupee or US dollar is still an asset. Let's say it's still liability, but still an asset you are comparing. Price is always measured relative. So like it's need to asset. Let's just say how the relation work. Good news in Bitcoin, the Bitcoin relatively goes up in terms of Indian rupee because people are willing to get rid of INR to get a piece of Bitcoin. Basically, you are selling INR to get Bitcoin. Let's just say when you are buying a chips packet or like anything from a grocery store, you're basically giving away your money. You're getting rid of the money or cash you have with you to get the hold of another asset. Let's just say you are thirsty and you are paying 20 bucks. Basically, you got rid of the 20 bucks and you got the water bottle for 20 bucks. So basically, you gave away some cash. You don't want it anymore and you got the water bottle. So basically, everything is a transaction and it's always relative. Nifty INR is up because there was bad news for Indian rupee. People sold INR and bought Nifty. And like over the years, I have noticed like people are so puzzled, like why people buy some asset, like when there's no news, or why this is going up, like why housing finance is going up, or like why gold is pumping. Like people only look at the primary thing like Nifty, Bitcoin, IRCTC, gold, houses, but no one cares to look about the secondary pair, Indian rupee, US dollar. There's also an auction happening for it. If you just flip the charts to INR Nifty, you will see the game there. Like people are willing to hold or get rid of something. So most people look at the currency in terms of currency, secondary assets on the chart. For example, I'm more interested in holding and earning Bitcoin than earning INR rupee. Interest rate, bond yields, inflation, war, news, how they affect currency. Yeah. If you look closely to money is not real. It's just psychology driven by fear and greed. Think about it. Think about it. It's all just an auction for everything. I've, the next video, we will be discussing about interest rate, bond yields, and how this impact the secondary pairs or secondary currency in rupee or dollar or any other currency. So see you next time.